Well, I think the high inflation rates we see now, which are approaching 10% and may even go above that, roughly equally divided between the monetary policy response during COVID and the recent impact on food and energy prices of the Russian invasion of Ukraine. So I think the most important thing is that central banks made a serious intellectual mistake in their response to the pandemic. And if both demand and supply fall together, the worst thing you can do is to try and boost demand, because then you'll end up in a situation where too much money is chasing too few goods. And that's a very good description of what happened in 2020. There were too few goods because the economy in large parts had been shut down. And there was too much money because central banks decided that they wanted to demonstrate that they were there, they were doing something themselves. And so they engaged in significant amounts of quantitative easing. So interest rates have to go up. And if that means a slowdown in the economy, then so be it. I think the challenge for central banks really is that they should have not engaged in the quantitative easing that they did in 20 and 21. What that means now is that they need to raise interest rates by quite a lot. And the sooner they do it, the better, because I think if they do it slowly, the risk is that they will then end up having to continue to raise interest rates while the economy is going into a recession. And that's going to be difficult for them to explain, and it will damage their credibility further. So I think that there are big short-run challenges, and for this to avoid a period of recession or stagflation, I think would require a lot of good luck. It's not impossible, but it would have to be luck rather than, I think, something which policy can bring about itself. A more likely scenario is that we end up having to move towards a period of stagflation in which inflation remains higher because the increase in inflation we've seen starts to get embedded in inflation expectations. And that leads both employees, but also employers, to agree that higher wage rises are justified. And that feeds through to a second round of inflation. So I see QE as, a normal monetary policy instrument that can be used. It influences directly the amount of money in the economy. But you have to ask the question, does the economy need to have the money supply boosted or contracted? And in 20 and 21, they went far too far in one direction. And in 2009, we stepped in to print money in order to stop the money being created by the banking system from falling. So it all depends on circumstances, and monetary policy should be seen really as a counter-cyclical instrument. And if the problem you faced is not a cycle, not a very short-lived problem, then monetary policy is not the right answer. My guess is that if interest rates go back to anything like the level they were before the financial crisis, we got back to interest rates moving between, say, 3% and 6% over the course of a normal business cycle, then you would see asset prices fall relative to incomes quite sharply. So I think the next 5 to 10 years will see a significant degree of debt restructuring of many private companies, the zombie companies that will have now to admit that they can't continue either to service their debt or to repay the principal of the debt. And also in terms of sovereign debt, where the IMF estimate that something around 80 low-income economies will need their debts restructured.